two. Welcome to another episode of Million Dollar Stories, where we get to interview authors from all over the world. I love talking to authors because they have some expertise that you might not know or we might not know. And so, if they have the courage to take their thoughts, their stories, their lessons, their expertise, put it down in a book and share it with the many, they're ultimately going to change the legacy and their destiny in the process. And if you're out there and you're looking to write a book, check out dreamstarterspublishing.com. We can help you out with wherever you're at in the process. And if you have a book and you want to generate leads with it, check out bookmarketingcrm.com. Now, most people who listen to this podcast are entrepreneurs or wanting to be entrepreneurs. And in order for you to have some grasp of the business, you have to have an understanding of accounting to some degree. And I think that's why this next guest is going to be very beneficial for you. He wrote a book. Are you ready for this? Fair Value Measurement, Practical Guidance and Implementation. And if you are, wanting to know a little bit about maybe how to do things the right way, or even what fair value assessment, or just having some type of understanding to have a conversation with high level accounting individuals, I think this podcast is going to be perfect for you. So it is an honor to have you, sir, Mark Zyla, with us. Thanks so much, man.
Thanks. Great to be here.
Well, this is more of a textbook feel, right? That's what this book is like it's a real general understanding of pretty much everything, it seems like, more so than just the fair value measurement. So what made you, I'm looking through and I'm just kind of glancing at the book, but what made you want to sit down and write this book? And if you can give the audience and the viewers maybe a quick little background on who you are and where you come from, I think that'd be helpful too.
Sure. Yeah. Let me start with the background first. I'm a certified public accountant, as you mentioned. I have somewhat of a background in accounting. My main background, though, is in finance and valuation. So I am an expert in valuing companies and valuing interest in companies. And the reason for writing the book is that it's become increasingly important in the valuation of businesses to understand what components of the businesses are actually driving value. And under the accounting standards, particularly when one company buys another company, but even as entrepreneurs build and develop a company, they have to understand the components that create value. And a large part of the value, particularly the type of entities your audience likely to be creating, are derived from intangible assets. Assets like customer relationships, technology, trade names, reputation, and so on. And under the accounting standards, the accounting standard setters saw that when one company buys another company, they're actually buying these kind of assets, particularly for technology companies, more rather than hard asset companies. And so they've changed the accounting standards where when you buy a company, you have to record on the financial statements what you actually bought. So these specific assets. So not only the overall value of what the company you bought, but the components, and that includes intangible assets. And as the standards change, valuation professionals like me, the profession started developing best practices, and so I implemented these best practices in this book to help business personnel, entrepreneurs, students understand these concepts and learn about the best practices.
Wow. Yeah, and you talk about the intangibles. I think that as we go through this development of a business, we're capturing so much data, so much information, and I
Mhm.
don't know how you put a price on it. I know many people who've sold their businesses, and they will tell me, "Hey, that customer list that you have is extremely valuable to X, Y, and Z." And I mean, maybe I can only base off of what they've paid us, and therefore I know what they're willing to spend if it's a recurring model. But data in general, probably going forward, you're going to see that as the ultimate valuable asset, right? Am I right?
Yeah, exactly. You think about it like you have two businesses. One has they're exactly the same, except one has customers, the other doesn't. If you're looking to acquire that business, which one would more likely have more value? And obviously, it's the one with the existing customers. You don't have to go out and develop customers. There's already cash flow generating for the business and so on. So the idea behind identifying these specific assets, both for accounting purposes, financial reporting purposes, but also just for managerial purposes. You have to understand, the value contributed from those types of assets.
Hmm. So have you seen one thing that we always like to talk about on this podcast is just increasing net worth, increasing financial freedom. So have you seen somebody do something very wrong? You went in, maybe potentially fixed it or saw them fix it, and then boost the value of their business pretty much in a very short amount of time?
Yeah, I mean it's typically involved when rather than maybe a pure startup, it's more of when one company makes an acquisition of another company,
Got it.
just providing some guidance of actually what you're buying. They kind of have an idea. There's some rules of thumb of how much to pay in an acquisition, but what we're the consultants, like valuation consultants, like our firm, we come in and help them identify, okay, here's where the value drivers of this particular business are. It's the technology, it's the reputation, it's the brand, it's the personnel, the workforce of the business. There's a lot of institutional knowledge in the employees. And so we help companies identify that and help them maintain that value. So when they identify where the actual value drivers are, they can nourish those value drivers and enhance value.
When I first saw the title of your book, it made me think of what was happening in the news, and it still is at this time. But Trump and Mar-a-Lago, what
Yeah,
is Mar-a-Lago worth, right?
right.
And in my opinion, it's based off of what is somebody willing to pay for it, therefore it kind of ties in with all of the historical data that's around them. So you get two aspects: what's the market willing to pay for it?
Yeah,
And then number two, what has the market already paid for that's close to it? So you have that, and now you get the assessment. So in your first chapter, you do talk about the history and evolution of fair value
mhm.
accounting. I would assume that somewhat ties in with, oh, well, um, maybe it does depend on what people are willing to pay for it. Maybe have enough consensus of a group of people for them to pay for it. So I don't know if there's any way to tie that together. If you want to talk about Trump, some people don't, but I think that was really relevant with what was happening
Yeah,
there.
I mean, one way to think about it is to your point, and we can use Mar-a-Lago as an example. You've got the value of the physical property, the real estate, and you can look at, even though there's not a lot of similar properties, but you can look at similar properties. You can look at what it would cost to rebuild the property. You can look what others sold for, and so on. And the cash flow from the resort aspect of the facility and so on, and come up with a valuation of the property itself. What I think Trump is arguing is, and rightly or wrongly, I'm not making a judgment, but one way to think about it is there's some intangible value perhaps there because he owned it. His name is associated, and you can see that with his branding, with buildings and casinos and all his properties. He sticks his name in it because in his view, he believes that enhances the value. It's just having the name is an intangible asset that enhances the value well beyond just the real estate value.
Yeah. And I'm glad you bring that up because branding in general boosts the value of a product. It could be
Yeah,
the
definitely.
exact same product, but if Apple signs off on it, or if an individual who's a very well-known person signs off on it, it's going to automatically carry a premium, right? So
Yeah.
um branding in
And
general.
it cuts both ways also too. If something's negative associated with it, so there's a concept called ESG, environmental, social, and governance, that enhances the reputation. If companies are believed to be good corporate citizens, their valuation, their brand tends to be a bit higher because they're viewed in a more positive light. But it cuts both ways. If you're viewed negatively, then it impacts your brand, your intangible assets, thus the overall valuation of your business.
Wow. Yeah, and I've heard of ESG. I don't know if that's it. You're towing the line of social credit scores, which gets a little scary. Am I right?
Yeah, yeah. There's definitely in it. It's an evolving concept, evolving. There's difficulties in measuring ESG, but as it relates to intangible assets and overall value, there is a school of thought that believes that the reputational value from being a good corporate citizen and following and adhering to ESG policies perhaps can increase value.
Yeah, I guess I mean it sounds very much like communist China from what I've researched and were able to pick up on. You know,
Yeah.
if you play by their rules and if you do everything the government says, you're a good little boy. You can basically eat this. You can eat dinner tonight.
Yeah,
Sounds fair.
yeah, yeah. And the argument is, it's already captured. And then there's the other argument, maybe it isn't, that kind of thing. So
Well, can you go into the history and the evolution of fair value accounting? Whenever I first got into this, I had no idea what the difference was between cash and accrual based accounting. So, like knowing the history and the evolution, I'd love to for you to kind of dive into that for our viewers.
yeah, typically accounting is based, at least US GAAP, generally accepted accounting principles, is based on historical cost. So, you buy a piece of equipment, you know what you paid for it, that goes onto your books as the value of that piece of equipment. And that's worked really well for a long time. And particularly when industries were more fixed asset intensive. Fair value accounting came into more prominence about 20, 25 years ago when we saw the first merger and acquisition boomed that resulted from the development, the commercialization of the internet, when companies were buying other companies for their technology, for domain names, for various other assets. And the accounting standard setters thought, they're buying something, they're just not buying goodwill. Because at the time, most of the value ended up being goodwill and amortized over 40 years. So they changed the accounting rules that said, okay, now when you buy a company, rather than historical costs, you have to identify what you actually bought. So that's where we see all these intangible assets like customer lists, non-compete agreements, trade names, so on, being valued and put on balance sheets and amortized over their remaining useful life. So that's been evolving over the last 20, 25 years. Valuation professions have been developing best practices to value those specific assets over during that time period.
So the world started to change in the accounting world, very much changed right around what the late 90s. The dot-com boost. How do you value something? How do you depreciate it? All of this was so new. It seems like that is a turning point. Is that right?
That's exactly right. Yeah, if you think about it, the economy shifted from, at that time was primarily, we made stuff, bricks and mortars, to a more information-based economy, and that involved value that's being created from intellectual property and intangible assets. So the accounting standards had to change a bit to reflect that and make it relevant for the users of the accounting standards.
Now, you never really think about it, but obviously the dot-com boost, you're like, oh, a lot of people made a lot of money, and it was really cool because it was this wild, wild west. But oh
Yeah.
my God, if you think about it from an accountant's standpoint, it is so open that, hey, what is this?
Yeah.
I mean, there's the roles haven't been written yet, right? It seems
Yeah.
like
Yeah.
with all that new technology and everybody probably had their own viewpoints, and maybe court cases were going
Mhm.
that were happening faster than ever. But what was that like? Were you in that world in early late
Yeah, yeah.
90s?
I mean, it was from a valuation perspective, it was interesting in that if you recall, one of the first um, companies that in that domain in the commercialization of internet that went public was Netscape.
Yep.
And up until that time, companies went public. You had to be growing, you had to show a profit, you had to to entice investors to invest in you as a public company. Netscape was one of the first companies to actually go public where they weren't making any money. And it was almost a backwards kind of a situation that as soon as companies started making money, investors saw limitations in growth opportunities. So actually valuations dropped, and it seemed counterintuitive and it was backwards. And so there were different valuation metrics that were developing based on page views or eyeballs, on websites and so on. And as investors were just trying to figure this whole new domain out. And so it's taken a while for the accounting profession, valuation profession to kind of catch up to those concepts.
And you may be able to answer this, you may not be, but when it comes to obviously attention equals currency. If you have attention, you have market value to some
Yeah.
degree.
Yeah.
So a website that might offer some type of solution or is able to get some eyeballs to it, how is that calculated? If you were to take it to account, what do they do? What's the process look like? Because there are many of my clients that have a lot of views, and then there are some that have no views, but they're cash flowing like crazy on the back
Yeah.
end because potentially they have an incredible business model. But the website, how do you value that?
Yeah, so I tell students I do some teaching in addition to my consulting practice, but I tell my students that at the end of the day, valuation boils down to three simple concepts. One is cash flow that you touched upon. The other is the risk of actually receiving that cash flow. And then the third item is growth. So if you look at any type of valuation methodology, whether it's a discounted cash flow, market multiples, transaction multiples, so on, it all still ends up boiling down to those three aspects. So to your question about how do you value a website, you look at, is it generating cash flow? Is it creating growth? And what's the risk of this actually being used? And there are now valuation methodologies that can carve out the value of that specific intangible asset, the website or the domain name, compared to the overall cash flow of the business.
And when you say growth, there needs to be a historical trend of it constantly increasing with a systematic approach, right? That's what you're
Yeah,
saying.
I mean that's one way to do it. It actually valuation though is future looking, so it's great to have a history, and that provides some confidence that the growth will perhaps continue in the future. But you need the growth that you're concerned about is what's the future growth, and that sometimes is difficult to estimate. But you can use historical growth as a track record for sure.
Hmm. Now, another thing that I was told whenever I first got into business was make sure your books are in order, not just because you want to know where you stand, but just make sure that when you go to sell it, you weren't trying to save money at taxes by whether it's constantly, investing into new equipment. You
Yeah.
were doing things in a way that showed that it was profitable. So trying to save your money at tax time is going to hurt you in the long run. And there was one of my first clients. He kind of showed me the light that, hey, I probably lost out on a multiple because in the first couple of years of my business, I was going to December and saying how much money can I reinvest so I didn't have to pay as much in taxes.
Mhm.
Well, when he went to sell it, they went back to that and said, oh, well, potentially that kind of was a negative, and therefore it probably detracted from the multiple they gave him. So
Yeah. Yeah.
nowadays, when he builds businesses, he's always saying, forget about trying to be clever. Start growing your business so you have an incredible looking asset on paper,
Mhm.
and therefore it becomes a much higher asset when you go to sell it. Am I right? Was he on to
Yeah.
something there?
Oh, exactly. One of the keys to enhancing value, and particularly if you're thinking of developing a business and selling it down the road, is just a good practical tip is transparency. So when a potential acquirer comes in to look at the business, you want to be as have them sign an NDA and all that kind of stuff, protect yourself, but be as transparent as possible because the more information you're able to provide a potential acquirer, the less risk that they view there is investing in your business, whether it's investing in the business, whether it's buying the entire business or so on, the less risk, the higher the valuation. So it goes back to those three basic concepts I mentioned just a few minutes ago. So, if you look at public companies, you look at financial disclosures required by the Security Exchange Commission, it's transparency. As much information is possible that the SEC requires in their disclosures so that investors can make an informed decision because it helps the capital markets, it reduces risk, and so on. So you're exactly on point.
What other mistakes have you noticed maybe early entrepreneurs make? Once you get to a certain point, when people always say like, "Oh, look at Trump trying to save money." Do you get this? I mean, if you get to a point, if you're making billions and you're doing your own taxes or you're even involved in the tax process, I mean, you've done something seriously wrong, in my opinion. So I think it's always handed over to the experts. So there's only a certain point that you need to get to. But what are some of the early mistakes that entrepreneurs are making that you've noticed?
Yeah, businesses as a startup, as they evolve, tend to go through certain phases. One's just, first of all, it's an idea. They get investments from friends and family. And as they start implementing that idea, they start getting investments from others and eventually more sophisticated investors like private equity, venture capital type firms. And as they evolve along that line, some of the mistakes that they tend to make is they still take on too much themselves. As they evolve and the business becomes more mature, you have to hire additional management. There are others that you can rely upon, outside advisors, professional management that enhance the value of the business. Don't try to do too much yourself and save money in the short term. But if you could bring on a professional team, it lowers the perceived risk. It'll help you grow, and it won't stretch you. You won't be stretched too thin.
Yeah, I think, people who are doing their own taxes, even if they're just a solo entrepreneur, I think they're hurting themselves, right? Because
Yeah,
somebody who's going to do all that work for you knows so much more than you could possibly ever know because they're in that world and they're going to be able to advise you on what to do, what not to do, and they're going to help you set up an S corp. They're going to help you set up maybe legal documentation, whether it's going to be an LLC or maybe a certain type of partnership. But it's all the stuff that doesn't really make you money. It protects you and maybe saves you money, but really, when it comes to making money, you, the entrepreneur, needs to be focusing on revenue producing activities. And that technically is not a revenue producing activity. Am I right?
right. Exactly. And even though there's upfront costs, for example, but having a good outside accountant, good outside tax advisor, good outside legal counsel is invaluable, save you money in the long term. And even though there's enough, obviously an upfront cost to pay their fees.
Oh yeah, yeah, and I mean, eventually you're gonna need one. So I think it's about relationships too. So
Mhm.
build a strong relationship with somebody early on, and you probably will be with them
Oh,
to a certain
absolutely.
point, maybe potentially for your life. I mean, I've seen people stay with accountants for many, many years, and then I've
Mhm.
seen other accountants that say, "Listen, once you break X amount of dollars and you're in this certain spheres that I'm not in, you might be able to be better served somewhere else." Right? So like there are levels to this game, and I'm assuming you've seen that where once you get to a certain point, maybe there are different programs or different people in place that could help you out better.
Yeah, as you evolve, particularly like from an investment standpoint. So entrepreneurs, you're going to eventually, as you grow your business, you're going to have to seek eventually likely have to seek outside investors. So it usually starts off, the friends and family, type of a situation, but then you get more sophisticated investors, and as the business grows, they're in addition to providing investment advice, they can also provide business advice. They're perhaps sit on your board. They know they have relationships with recruiting firms that know the individuals that you might want to retain and bring into the business, and that'll help you grow. They have relationships with other advisors, and those kind of relationships are invaluable because the general entrepreneur, as you mentioned, focus on your strength in building revenue, building the business, and then rely on the outside advisors to help you with the other stuff.
Well, what got you into this world? I know that it probably takes a certain personality to be just drawn to the numbers and seeing how it's a puzzle. But what made you fall in love with it? Was it something that your parents did, or maybe you just came across it when you were in school? What was it?
Yeah, basically school. I had undergrad and then MBA in finance, and then at the time, Arthur Anderson was one of the premier firms, and they were looking to hire valuation experts. And I, you know, knew the name and knew the reputation, great, awesome reputation at the time, and joined the firm. And I just fell in love with the valuation aspect, the consulting side of the business. Every situation's different. Every company obviously is different, but dealing with different individuals, different purposes of valuation, kind of understanding different industries, looking at how management handles problems. As in the role that I have as a valuation consultant, I get to see behind the scenes on all these kind of things, and so I've learned a lot. It's just interesting after all these years.
You probably get to see very, very clever strategies when it comes to asset creation or asset building. So, is there any one or two strategies that really stand out in your mind as something that kind of shocked you? Maybe you saw a company do X, Y, and Z, and it really led to an incredible success rate, or anything that stands out that the audience would love.
Yeah, I mean, one of the things that, and there's been a number of situations, but one of the things that a couple of industries, but a couple of companies in particular have done to help grow their business is they pattern themselves after other businesses. So they may make a location, like for example, if you're, this is just a general example, but if you're a fast food restaurant and you're franchising, the way you perhaps locate different franchises is based on where others are placing franchise. So it's no accident that certain exits on interstates, they all have the same 4 or 5 different franchisees there. They tend to follow one. So companies look for the leader who has the best reputation, and it may not even be the same exact industry, but somebody has a great reputation, for example, just picking great locations, see what they're doing and then pattern yourself after what they're doing. So there's a lot of that it's helpful, and it's basically free consulting.
Now, have you worked with some very big companies,
Oh
or are
yeah.
these okay? So I would assume that, one of their strategies is buying other businesses, whether
Mhm.
it's competition or bolt-on businesses.
Yeah.
And I'm in some circles that these individuals, they just love, the phrase is boring businesses. They love buying boring
Mhm.
businesses. And it could be HVAC companies, it could be roofing companies, it could be gutter companies, whatever it is. And the reason why is because potentially it's great cash flow. There's always going to be a demand, no matter how crazy AI gets. But it's most likely one of those things where you can bolt on to other businesses. So
Yeah.
there's a built-in demand that they can constantly relay leads to, I guess, if that makes sense. So
Yeah.
um, when I look at maybe the next business that I want to get into, it has to be in the book world to some degree. Now, I realize that there's all this possibility out there, but is one of the strategies that you've seen in these big world or big companies, one of the things is they buy only what they know, and that there's always a built-in demand, a built one that they can bolt on, I guess is probably the best way to put it. Is that something you've seen? Is that a common trend?
Yeah. Yeah. Particularly, you look at it from we see it from a couple of different viewpoints. One is the corporation. So if it's a large corporation and they're expanding, they may go out and buy mom and pop companies in the same industry as a means to grow. And they generally, in those situations, they stick to very similar companies or products or business lines that they're currently in. We also see work with private equity firms where they'll buy a platform company, and they'll buy a company that looks like it's generating tremendous good cash flow, but can be used as a mechanism to buy companies that have synergies with that particular company, and they can bolt it on. And so their strategy is not only grow through acquisition of the same businesses, but also industries, similar types of industries where there might be some synergies. Like for example, in your business, the book business, there might be there's publishing aspect, there might be a communication type aspect, and so on. So you can look for companies that you want to add on that you can have complementary types of either customers or serve products and services.
Well, I guess it starts with, and I have a client that's he fixes houses, he flips them, and he also does mobile home parks. So one of the businesses that he wanted to start or get into was a junk removal business. He's already paying for it, right?
Yeah, yeah,
So why don't I just create one or buy one? Because rather than just be an expense, technically it's going to be just one of the costs of doing business. So it's not
yeah,
paying someone else. He'll get it at, I guess you could say, wholesale prices, So,
yeah,
uh,
yeah.
uh, so if there's somebody out there listening, and obviously the accounting side, is your bread and butter? If someone's about to buy a business, what would you say for them to look at or to evaluate? Is it, and this probably would help them get a better deal, whether it's debts or, certain lifetime customer value or, brand value or fair market value assessment. What would you say to them to look out for when it comes to the numbers?
Sure. So as far as their look at type of information, I mean, one, look at the quality of the information that the target company is able to provide. So the better quality, more transparent that company is with providing their information, then it lowers your risk. You have a better feel for it. Secondly, look at the is best one's able to do. Look at your gut feel about the integrity of the person that may be selling the business or the target. And that's sort of, it's pretty nebulous, but you want to feel good about if you're buying from that person because they're you just have a good feeling. Also, that also lowers your risk. The third thing is, as best you can, understand how the business makes money, and it doesn't seem as simple as it first appears. You can kind of know what the business is in line, but think about the strengths. Do sort of like a SWOT analysis. Look at how well protected the cash flow generating ability. If the seller is selling the business and the business is tied to that individual's reputation, if they sell and then leave, does that going to impact cash flows? Is there, but so you may want to think about ways to, keeping them there, aligning your interest with their interest in selling the business. So there's a number of things that you think about when you're making an acquisition to understand how the cash flow is generated, reducing the risk and the growth potential, which is the basics for the valuation. And then afterwards, you want it as part of the accounting side where valuation consultants may come into play is not only pricing, helping you price the business, but also understanding what you actually acquired for financial reporting purposes. So understanding the intangible assets, how much value each one typically is generating and how you can protect that value.
Okay. Yeah, I was a finance major also at Duquesne University. What school did you go to?
Undergrad, University of Texas, and then Georgia State University for my MBA. So you
Okay.
went Duquesne and Pitt,
Duquesne. I was real
Pittsburgh?
close. I'm still in Pittsburgh, Pennsylvania, but
Okay,
I
okay.
would party at Pitt, but then I would go to school at Duquesne University. That's how it
My,
went.
my,
So,
my dad's proud graduate of Duquesne, by the way. So,
oh no way! All
yeah, the
right,
Dukes.
that
Yeah, we know
alone
the Dukes.
was he also in the business school or they're very well
No,
known
he
for
he
law
he went
schools.
into public health. He worked for Center for Disease Control. So
Oh,
he
gotcha. Well,
yeah,
they also have a very good reputation when it comes to whether
yeah,
it's the health sector. So health, law, and business. That's what
yeah, good
Duquesne really
school.
is well known for.
Yeah,
Wow. So he
yeah,
works for CDC?
yeah. Or he did. He's been retired.
Got it. Interesting. Wow. So he probably knows Anthony Fauci then, huh?
He's been in the same room with him.
Wow.
Yes,
Wow. I love that.
long
You
time
talk to
ago.
is your dad is still around then? Is
No, no, he passed away a couple of years ago,
Oh,
actually.
I'm sorry to hear
Yeah.
that. I was gonna say get him on here. I want to talk to your dad about
Yeah.
Dr. Fauci. Anyways, so whenever I was in school, accounting too was the hardest class for me. Maybe it's because I
Yeah.
was so infatuated with a girl at the time, but I couldn't pay attention. It was so hard. And it's because I never understood widgets and all that. It didn't make sense
Yeah.
to me. The
Yeah.
moment I get out of school and I start a business, everything starts to kind of like piece together and I get excited about it because now I see how numbers really, because they're real, right? That's your money, right? So
Oh, sure. Yeah.
I started to pay attention to the numbers more. And nowadays, I have a bookkeeper. She goes through everything once a week, and my accountant looks at it at least once every quarter. So when it comes to real accounting with the higher ups, with the big companies, what's the process that's in place there? And what do you recommend to the everyday entrepreneur listening? I know that it took me a long time even to get to this degree of a bookkeeper checking the books every week. That took a long time to get in place because it just wasn't there. But now that we have momentum and energy, you got to do things the right way. Therefore, you catch things whenever things go sour. So, what have you seen? What is taking place at the highest levels? But also, what do you recommend to the everyday entrepreneur?
So for the entrepreneur, your point is extremely valid as far as do it the right way. So make sure you set up systems as you're starting out, and then as you start growing, it may make sense to, start having a bookkeeper on a part-time basis. There are now online bookkeeping services that are very helpful. My earlier comment about, eventually you're going to need a accounting and outside accountant to help with your taxes and provide just general accounting advice. So do things the right way from a accounting standpoint, because it goes back to all the things that we've been talking about as far as enhancing value. Your accounting system at the end of the day is going to be the one that's how people are going to look at the business itself and the measurement, right? The numbers
Yeah,
are
that's all it
tell your
matters,
story.
right?
That's all
I
you
mean,
got.
that's
Yeah,
it.
exactly. So they're going to tell your story. So make sure you're transparent about it. Make sure it's done correctly the right way to have, confidence in the systems and so on. So you don't have any issues down the road.
And QuickBooks Online is what I recommend. I'm sure that at the higher levels, they're using a completely different system, but QuickBooks Online and having a bookkeeper, right? Once again,
Yeah.
part-time investment.
Yeah.
But having it clear as day from the beginning, it's one of these things where it's like about creating great habits, right?
Yeah.
And
Yeah.
you amplify those habits over time. But in the very beginning, for me, I used to say, well, I'd get to my books, I'd get them in order every couple weeks. That would go to 3 months, 4 months, and then I'd spend hours doing it every 6, 7 months. So,
Yeah. Right.
doing it from right from the beginning, not that hard if you have a bookkeeper that's once a week for a couple hours. That's it, right?
Yeah, yeah, and there's online services that you could, in a secure manner, you could give them access to your books and your banking records and so on, and they can prepare stuff so it's on a real time basis. You know where you stand with your financial reporting.
How often should an entrepreneur meet with their accountant, right? A bookkeeper is just the labor behind making sure the books are in order. And there's an accountant that is sort of the expert. It's almost like I always think of it as like a surgeon, like the doctor. You're like, all right, let me talk to people who are, not as expensive. And then when I need to make decisions, let me talk to the surgeon, right? So like
Yeah,
that's the
yeah.
way I look at it.
Yeah, I mean, if you have a really good bookkeeper and you're following your own financials, if you meet once a quarter with your accountant just to make sure things are progressing as they should be, it might be a very short meeting, but at least you have comfort that everything's still on track. But definitely, at least once a year in preparation for filing taxes and so on, you're gonna need to sit down with your and spend a little bit of time with your accountant on you preparing tax returns and so on.
So, and you're one of the first people to be on this podcast in regards to this, but when it comes to evaluating the net worth or the value of your company as it
Yeah,
is,
yeah,
there are probably companies out there. There are probably people like you that come in and be able to do an assessment. How often should a company do that, and where would they look to even do that?
yeah. So there are a number of different reasons for evaluation. So typically, unlike say preparing tax returns or financial statements where it's every month or once a quarter, so on, evaluation is more event driven or purpose driven. So and some of the purposes might be somebody wants to buy your company, or you want to buy another company, you may need to assist in evaluation. Or if you're setting up, if you're bringing in additional investors, you may need to have your company valued because the outside investors may want to know what they're getting and what it's worth. If there's a litigation, if there's tax reason, you're giving away shares in your company, there may be reasons. So it's event driven. It's not a once every X number of periods. So that's the first kind of concept for evaluation, or the requirement for evaluation. The other is that there are numbers of different experts in that provide valuation services. Typically, they're either independent, like my consulting firm. They're valuation consulting firms, but there's also typically, as part of accounting firms, they typically have, as part of their consulting arm, they have valuation consultants, people that are credentialed in valuation to assist their clients with valuation needs.
Yeah, and so I want to make sure we have time to talk about this. Xyla, it's XylaValuationAdvisors.com. If they went to that, what would they
Yeah.
find?
Yeah, they would just find background about my firm and my background and the type of projects that we generally have worked on or working on.
And so if they went to that, like, who is your target client or target audience member or somebody that you can really help? What stage are they at?
Yeah, usually it's most of our clients are a little bit later stage companies, so they're mid-sized companies. Generally, they have they're generally private equity backed entities, so they're at the little bit of a later stage. So they're beyond the startup area, it's generally for the purposes that we've been discussing. It's either they've made an acquisition, and so they need to understand what they bought for financial reporting purposes, or they're developing a employee stock plan where they're giving shares of stock or options, and so for tax purposes they need valuations to report to the IRS, or there's a dispute, so they may need outside expertise to help them with a valuation, work with their outside legal counsel in a valuation dispute. So it's purpose driven, and it's usually that mid tier size to large public companies that we tend to get involved with.
Wow, some complicated agreements, I'm assuming, right? It's
Yeah,
probably
yeah,
exciting
you
to
see a
see
lot.
how it all meshes together.
Yeah,
And with everything that's happening with technology and crypto, I'm assuming individuals, when it comes to buying certain companies, there's ways that you can do it, and it gets very complicated. But probably there's a certain trend that's happening that you're noticing, and you might be on the forefront of many things that other people just don't see. So, is there a trend that's happening when it comes to private money, or whether it comes to certain organizations? I mean, BlackRock going around buying up. I think they were buying up a lot of single family housing before. Maybe they still
yeah,
are.
yeah.
But is there any trends that you're noticing that might be either exciting or scary to you?
Yeah, I mean, I think there's a lot of activity, and these are kind of, you could kind of just in the business press kind of pick up on, but, healthcare is hot right now. Just as the population's aging, there's clearly a growth aspect. Different environmental type things because the government's, pushing
The
more
ESG stuff.
environment,
Yeah, you're right.
ESG
That's
stuff.
right.
Yeah, that's a pretty hot area. Um, Private equity, interestingly enough, is investing in professional service firms. So there's been a lot of there have been acquisitions recently of accounting firms and other consulting firms by private equity, and
Wow.
they're looking at that as a growth model, which has been there's a lot of issues with that because in accounting, for example, as one example, you have to be licensed, and the owners have to be um, licensed CPAs, so they have to restructure to fit state regulations, things like that. But they're investing in professional practices now. That's an interesting area that we've noticed that private equity has been investing in recently.
Wow. Last question I got for you. Are
Yeah,
people buying up the I mean the trades. I mean, I know the trades are just booming with they're able to write their own tickets, plumbing companies, right? I mean, we're talking
yeah, oh
about the
yeah.
boring business of the world. Is private equity getting behind or buying up those type of companies?
I haven't noticed that trend yet, but I think it's likely because of just the total infrastructure is changing. The emphasis on the infrastructure in the U.S. and bringing the supply chain back and so on is creating this boom in investment in just infrastructure. And the companies that you mentioned, the plumbing companies, the trades, and so on, are clearly a vital component of building that infrastructure out. And so you're going to see a big growth in that area. And so I think if they haven't already started in that area, you'll see a lot of interest and investment in those type of entities.
I know that there's a growing demand and a very short supply, right? Less people are getting into it, and therefore they're able to charge whatever because people need
Yeah.
it.
Oh yeah.
There's no way around it.
Yeah.
That blue collar tradesman is going to be able to become probably way wealthier
Yeah.
than those who are going to college for sure.
Yeah. No, yeah. Just the trends. Yeah. The demands, outstripping the current supply.
Yeah, I could probably talk to you for hours when it comes to just ways to set up your company the right way because, like I said, I didn't care in school, But once it's your own business and your own baby, you start to see how it all connects and you get excited about making sure it's clean, it's simple, and therefore it's valuable for not only yourself, but for others. Guys, the book
Exactly.
is called Fair Value Measurement, and it's the practical guidance and implementation. You can check out his book on Amazon, 4.2 review stars on Amazon, doing really well. But if you want to just take a look at his website, it's xylavaluationadvisors.com. And then you can find him on LinkedIn. Outside of LinkedIn, is there any other way to get in touch with you? Or you have a social media that you're quite active on?
Now, just the LinkedIn is the most common that I use.
Beautiful. So, okay, guys, be consistent, right? Do things the right way. Get a bookkeeper. All right. Understand that there's a lot of value in that data if you organize it the right way and do things the right way. So therefore, it's going to be a sellable asset whenever you want. So, Mark Zyla, thank you so much for being here, man. I appreciate it. I know that some people are like, accounting, I don't want to worry about that until next tax season, but you should, because it should excite you to see your net worth grow through your finances. So, thanks so much for being here, man.
Thanks, Mike. Thanks for inviting me.
Remember, guys, $1 million book will lead to a $1 million life. Right on.